Hi, this is DrMNP. Uh, Thanks for coming back. This is my presentation on the stock picks for the week of 10/21. So before I go through the picks, so let me first share my presentation. This is a presentation. Okay, all right. So before we discuss the stock picks, let's talk about how the market did last week, right? The last week, the market had a fairly good performance. It was a technical rally. It was fueled by Fed rate optimism. There was optimism that the Fed rate might pause once it reaches 4.5 or 4.75. And also there was some optimism that the consumer spending is holding up in spite of the fear of recession. So these were all good news for the market. So the market went up. So let's see if it holds up over the next few weeks. Next week is critical because we have the earnings report from big tech, and that may tell you how the economy is doing and how the various things such as the recession fear, the Fed rate increases, as well as the dollar value is affecting the stock prices or the stock performance. Okay. So for this week, I'm going to talk about 4 stocks, and these are in different sectors. The first sector is the technology, and here I have chosen semiconductors subsector. And the stock I'm going to talk about is ADI, analog devices. The stock right now is 146. The year-to-date performance is minus 16. Given that the overall market has done minus 21 or so, this stock has actually done a little better than the market, okay? The second one is the communication services sector I'm going to talk about. And the subsector is the internet advertising. And the stock I have chosen there is Alphabet or the Google, and the stock symbol is Google L. And that is right now 101. And the stock has done worse than the market. It has gone down minus 30%, which is pretty bad. And then the third sector I'm going to talk about is industrials, and the transportation is a subsector we'll talk about. And the company I've chosen is Union Pacific, okay? And it's a rail company. The stock price is 190, and it is down minus 24 year to date, again, which is slightly worse than the market. And finally, real estate sector is the one we have chosen. And there I'm going to talk about specialized real estate product called REIT. And then the stock I'm talking about is AMT, which is for American Tower. And the current price is 187. And that stock has done very bad, minus 36% over the last, YTD. So this one, is a good stock. So should we buy these 4 stocks right now? Or if not, at what level we should be entering, right? So that's what we're going to talk about. So let's focus on ADI. So analog devices. So it's a semiconductor company. It covers lots of markets, auto, aerospace, defense, industrials, medical devices, as well as media, especially high-end audio, right? And then it has several positives. What are the positives? It's a market leader. It has diverse customers, more than 6,000 customers, right? It has a high cash flow, and it has a good dividend history. It has increased the dividend, almost every year over the last few years. What are the negatives? It's a high-tech stock, so it's very sensitive to Fed interest rate. As the interest rate goes up, these stocks suffer. Their P multiple gets compressed, so that's a problem. These stocks, ADI actually was a beneficiary of the pandemic boom. Now the pandemic is ending, so that's going to be a negative for that. And the inventory buildup. So when the economy slows, some of the end markets may stop buying or slow down buying rather. And if their forecast is not good, their inventory starts building, and that could be a problem. That could put price pressure on their products. And then lastly, The downward pressure on EPS, what do I mean that? The stocks are basically driven by what sell-side analysts say about them. Right now, the consensus EPS is around 9.4, but going forward, there's a potential, there's a probability that the sell-side analysts will start bringing down the EPS. So when the consensus EPS comes down and the P also is compressing, the stock goes down more than you would anticipate, right? So given all this, what is the outlook for this stock, right? So we know over the next 6 months, the economy is going to be, going through some, pressure and potentially a recession. So that's a problem for this stock. And then the margin might compress because some of the costs are going up because of inflation. And also the pricing may come down because of inventory issues. However, the cash flow should do good and the dividend should hold. They may even increase the dividend over the next 12 months. So what is the consensus EPS? As I mentioned, is 9.4 for next year. The target price, when you look at the sell side analyst, is from 155 to 190. So the implied PE is 17 to 20. Okay. So that's the current status of this stock. Now, in terms of the company market cap, it's a large market cap company, 72 billion. And its dividend going forward for the next 12 months is $3.04. And over the last 5 years, the dividend has grown by a healthy, 10% plus. So this is a good stock, but the question is it a good time to enter, right? So let's do the analysis here. Before we do the analysis, let's look at the 12-month performance of this stock. In the 12 months, the stock has, gone up and down. It's a volatile stock. It's a high beta stock, and it is down 18% for the last 12 months. The high in those 12 months is 191. The low is 133. So there's a wide range, right? And the recent close is 146. So even at 146, even at the Friday price is somewhat close to the 12-month low, and it's not a bad entry point. But I think this stock is going to have, lower lows sometime in the next 6 months. So you need to be patient. So why do I say that? Let's look at the analysis here. So the modeling I did tells me that there's a high probability that the EPS consensus will come down over the next 4 months. And the model is saying around 10%. If it is 10%, the new EPS consensus comes to 8.46. Not only that, like I mentioned before, the PE compression happens, and the PE range over the next 12 months is going to be around 14 and 19. And this is based on where the P was in the 18-19 period when the interest rate environment was similar in the sense that Fed was raising the interest rate. So now use that P range and the forecasted EPS, then you would come up with a 12 to 24 low of 120 and a high of 180. So in the last 52 weeks, the low was 134, the high was 191. So it is going to have a lower low, and so that may be an entering point. So I would say that anything below 130 is a good entry point. If you are nervous, if you really are risk averse, you may want to see if it comes around 125. So I would buy that and then be patient, wait for around 12 to 24 months, collect the dividend, which is not bad, $3 per stock per year. And then if you really want to monetize this stock in the next 12 to 24 months and you want to sell it, then you have around more than 40% gain, which is not a bad deal at all. Okay. So the next one we'll talk about is Alphabet. So the Alphabet has two class of stocks, Google GOOG and Google L, which is GOOGL, Google L, which is the voting stock. So I will talk about Google L when I do the analysis. Now, this is in the media section. Specifically, is a subsector of the communication services, and it specializes in internet search engine, the advertisement, the video advertisement, and things like that. It also has um, the cloud services, right? The Google Cloud is a big provider. And what are the positives for that? This is a leader. No, there's no question about that. Market leader is a very high margin business, and it's a high cash flow, and they have tons of money. Okay, all these are good. So when a company has lots of money, and when the when the cash is more than they can use, and when the stock prices are low, there's a possibility, and there's a high probability that they will buy back their own stocks, and that's good for the price of the stock. So I think Google is a candidate for buybacks, in the next few months. So what are the negatives? The negatives are, of course, the Fed rate going up, the P compression as a result, potential recession, which will affect the advertising business especially, and then, the potential revision of EPS downwards. And Google also has this regulatory risk all over the world, whether it's Europe or Asia, countries like India, they're all after Google in terms of monitoring their regulations. And so that's a risk for them. They get fined. And when Google gets fined, it's billions of dollars. And in spite of all this, what is the outlook? The outlook is, it's tough for the next 6 months, especially in the advertisement area. And there's potentially margin compression. So we may want to be patient. But again, as I said, there is this possibility of buybacks, right? So let's see what is the consensus EPS right now. It's 6.8 for 2023. And the recent target price, what analysts are saying for the next 12 months is 115 to 180, which makes the P between 17 and 27. So there's a wide range of the target as well. In terms of the market cap, it's a mega cap company. So it's 1.3 trillion. This is one of the three companies that are above 1 trillion in terms of market cap. The other are Apple and Amazon. It doesn't pay dividend. It does not pay dividend at this time. It does not pay dividend at this time. So we need to remember that. So how has the stock done over the next, over the last 12 months? It has done badly, like I told you. It is down 28.72%. The high in the 52-week period was 151, and the low was 94. And the close on 10/21 was 101, very, very close to the low, okay? So what is analysis on this stock? The analysis. Again, I think there's a 10% cut possibility, potential for 10% cut in the EPS, and that would bring it to $6. And at $6, at the current price, the PE is 16. So it's not really a very expensive stock at this time. Now, the PE compression may take it to 15 to 25 for the reasons I explained. So what does that P compression imply with the new earnings, with the new EPS forecast? Low of 90 and high of 150. Okay, so the current low is 95 and high is 151. So it is going to be in a similar range for the next 12 months. So right now, it's a good stock to buy. It is in the low range. And I would say anything around 95 or below 95 for Google is a good buy position, is a good buying opportunity. And if you hold on to it for 12 months, there's a good possibility that you will make around 50% return. So this is a good stock to buy, especially since there's a good chance that there's going to be some buybacks. If there are going to be buybacks announced, if this stock is going to do good. Okay, so now let's look at the third stock, which is the Union Pacific Railway, which is UNP, which is again a large stock, 120 billion. Forward dividend is 5.2, which is a good dividend. And in 5 years, the dividend has grown by more than 13%, right? And as I said, this is a rail company. This is the largest rail company. and they are focused on the western part of the United States, the Midwest on the West Coast, and they connect the West Coast and the Gulf to the hinterland, the Midwest, industrial area, the grain area, and things like that. So they're very well positioned. And they transport raw materials, agricultural product, oil, and that type of thing, and industrial products. And they're also, you know, important for the foreign trade. So when things are imported from the Pacific Rim countries, they come to California, and a lot of traffic, a lot of goods are transferred, into the United States on ENP freight. So that's another market for them. As I said, they're very dominant rail company. And what are the negatives for them? Inflation is increasing their labor cost. They're going through a labor negotiation, and obviously that's going to increase their cost. They're cyclical. They're highly tied to the economy. So UNP, you can even look at it as a leading indicator. If the UNP announces a bad quarter, is usually telling you that over the next 6 months, the economy is going to be in trouble. And in fact, last week they did announce their results, and some of the things they said is worrisome. I'll talk about that. And also, this business is capital intensive. If you want to buy new rails, then they're expensive products. And if you want to buy, cars, rail cars, they're expensive products. They had to upgrade the network continuously. They had to automate it, that type of thing. So they had to spend money on that. Okay. So what is the outlook? So the outlook is, the economy is going to slow down. It is already slowing down, and there could be a recession. So it is going to have some problem, and the margin is going to compress. Okay. And right now the consensus EPS is pretty high, 12.7. The target price is still high, 190 to 270. So the implied PE is 15 to 21. So this stock, although it's in the lower point right now, may have some more, downtrend. Okay. So let's look at the stock picture performance for the next, rather for the past 12 months, right? So you can see in the beginning, people were optimistic. The economy was doing all right. So the stock went up, and it reached a 52-week high of 278. And then it really came down as people started realizing that the economy could be in trouble, going forward. And so over the last 12 months, they have lost around 17%. And whatever the earnings they reported, right, it was better than expected in terms of EPS and even revenue. But the guidance, how they were going to do over the next few quarters, was not good. They did tell them that the car load they're expecting was not that great. Was worse than they were forecasting. And also the buybacks, the stock buyback they were doing already, they were going to slow down it a little bit. So those were bad things for the stock. So the stock, took a hit last week. So what is the analysis on ENP? So this stock will have at least 10% cut in their consensus EPS over the next 3 months. So that should bring it to around 11.4. If you look at the the range of EPS during the slow economic times is around 14 to 18, and you use that as a guidance, and then you come up with your estimate for a low being 160, high being 205. Okay, so where are they for the last 52 weeks? The low is 187 and the high is 278. So I think there's a little bit of downward possibility for this stock in the next few months, and potentially around 170 or below. And at that point, you should buy it because it's a cyclical stock, and as the economy comes out of the recession, this stock is going to do very good. And usually the cyclical stocks bottom before the recession hits. So if you think the recession is going to happen around the second quarter or third quarter, then the bottom will happen either in the fourth quarter or the first quarter. So this is the time frame you should watch this. And when it comes around 170, buy this stock. Okay. All right. The last stock I'm going to talk about is the American Mobile Towers. So what is this company? It's a REIT. It's a real estate trust. So what do you mean by REIT? REIT comes under special, rules in which, they have to return 90% of their earnings to stockholders, shareholders. So as a dividend. So that's a good thing. So income producing, the income oriented investors go after these REITs. And this is a specialty REIT because they don't build any building. In fact, they don't build buildings at all. What they do is they build towers for cell phones. And they lease the space to mount, the antennas, the radios and that type of thing. And who leases from them? The big cell companies in this country, AT&T, Verizon, T-Mobile. They are their customers. They're all over the world, right? They are in Europe, they're in Latin America, they're in Africa, they're in Asia. So they have a global exposure, which is good and bad. And they're very big. They have more than 200,000 cell sites, and all their customers are large customers who have very good cash flow, and they have long-term contracts. So the recurring revenue is very good. So, at a fundamental level, this is a good company to invest in. But the negative is it's very capital intensive. Any real estate business is very capital intensive, right? And as a result, they have high debt. So when the interest rate goes up, the interest cost goes up. So that compresses their margin, that affects their earnings, right? So you have to watch. Right now, the interest rates are going up. And because they're global and because a lot of their earnings comes from overseas, when the dollar goes up, the earnings that is coming from Europe and Asia and Latin America and countries like that, or regions like that, goes down in terms of dollars. So that's another problem for this company. So it is going to have somewhat turbulent times for the next 9 months with some margin compression and with analysts downgrading, right, their earnings. Now, for this company, what is important is the FFO, the funds from operations, the forward FFO, the 12 month, what's the next 12 months FFO? So instead of the EPS for REITs, that's what people use, right? So the forecast for the next 12 months is around 10.5, which is not bad. And the recent target from the sell side analyst is around 200 to 300. So the implied price to FFO ratio is around 19 to 29. Okay, and that is the normal range, I would say, if the interest rate environment was in the lower regime, when it's low. But now that it's going up, this P to price to FFO comes down tremendously. So that's something we have to watch out. What about in terms of its characteristics? It's a REIT, as I said, its market cap is high, 89 billion. The forward dividend is pretty good, $5.88 per stock. And they have consistently raised the dividend. The dividend growth rate over the last 5 years is more than 13%, which is very, very good, right? So let's look at the stock performance in the last 12 months. So it was doing okay until the last 2 months when people started realizing how the interest rate is going to affect their interest expenses, how the dollar value is going to affect them, and then the recession coming in Europe. Europe is definitely going to be in recession, if not it's already in recession. And the stock really started going down tremendously. So from around 275 plus, it came to around $180, right? So the 52-week high was 294 in the last 52 weeks or 12 months, and the low was 178, and the close one was 187. Okay, so it is still around the low, but I think that the low will be even further down. going forward. So let's watch this stock over the next 4 months. I think, I forecast that the EPS, sorry, FFO, I should make it FFO there, comes down to 9.45. And then if you use the more normalized range of 18 to 26, when the interest rates are not very, very low, the low for the stock comes to around 170, and the high for the stock comes to around 245. So when you compare that to the low already, it's around 178, and the high for the last 52 weeks is 294. So it's not going to reach that high pretty soon, but it will reach around 245 in the next 10 months. So if you enter this stock, if you buy this stock when it's around $180 or below, there's a good return of 30% or more in the next 12 months. So I would buy it around 180 or below. And you also collect a 3.2% dividend, which is not bad. And then they will increase the dividends. As I said, they have a good record of increasing the dividends. Okay. All right. So those are the 4 stocks I've discussed for this week. And I will come back every weekend and I will give you a overview of what happened in the market the previous week. And I'll pick 4 stocks in different sectors and I'll go through the analysis in a similar fashion. I may compress them a little bit. This one I wanted to elaborate on to give you an understanding of how the thinking goes, how the model works here, right? And I will upload it during the weekend, and I hope you come back and you see my presentation. And thank you very much. So I will end my presentation here.